Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in. We are thrilled today to have on Swimming with Allocators Joshua Berkowitz. Joshua runs his own family office, Berkocorp, where he is responsible for having moved the investment focus specifically on real estate to backing top VC and PE managers. He's actively looking at managers at this very moment, so you should definitely listen in. Some of the things we're going to talk about today are what it's like.
As you say that, I can feel the tranche of cold emails arriving in my inbox.
We're leaving that in, by the way.
I can't wait.
Everybody, anybody, feel free to email Joshua Berkowitz.
Oh, God. What have I done?
Two of the things you're going to speak to today are who shouldn't email you and why, as well as some of the differences in underwriting PE versus VC, so that some of our LPs who are listening can learn what they might be needing to consider when looking at venture. Thanks so much for being here.
Thanks for having me. Looking forward to it.
Yeah, absolutely. You built your family office investment program from scratch on the venture side. Could you walk us through the thinking of why you wanted to add that in and how you approached it?
Sure. So we started as a real estate business. That was all we ever did for about 60 years. I took over. I was sort of happy with the real estate business, but if you know much about Canada's real estate market over the last, call it 5 years, well, call it 50. It's basically on a straight line up and to the right till about 2020. And since 2020, sort of a weird roller coaster in 2021, and now it's been flat, and there's lots of underlying structural challenges that make me think real estate as a whole in Canada is going to be troubled for a while. Mm-hmm. And so I wanted to diversify, partly because I saw that, partly because I think diversification is just good and manages your risk better, and partly because I just wanted to, right? Like I enjoyed meeting venture capitalists and thinking about new technologies. I enjoyed the same thing with the private equity folks. And so we still own and operate all the real estate that sort of was call it our legacy business. But we shifted focus to Diversifying because I thought there was more opportunity in the other asset classes. Venture specifically, I actually think venture is a really interesting fit for families like ours. One, it's very inefficient, right? Like the best venture capitalists are light years better than the worst venture capitalists, and the returns reflect that. And then similarly, the returns can be very good if you feel like you can consistently pick the top venture capitalists. Mm-hmm. And then, what's sort of the advantage that families like ours have, which is that we have a really long-term mindset. We're not huge spenders. We don't need the money. Eventually, we'll give it all away. We can be patient. In fact, we're sort of patient-minded design, and so the liquidity and the long-term thinking all fits well with sort of the family office mandate. And sort of the last piece of the puzzle is taxes as well. We don't have QSBS in Canada, but nonetheless, super long-term compounding assets that produce capital gains is about the most tax-efficient investment you can make. And mm-hmm. So also from a tax perspective, the fit with the family office of venture is really good.
Once you've done that, then it's like, all right, how do you start to learn and get good at it? It's still an inefficient market, even if you go in eyes wide open. But then how do you learn?
If you're going to do it, you really have to make a significant commitment of time and travel to make it make any sense. Like you should probably think you're going to have to meet at least 100 venture managers before you have a good sort of calibration on what good looks like. And probably you're going to have to do a bunch of bad deals first, or call it funds you wouldn't do a few years into the business, because sometimes it's going to be a lot easier to get into riskier, less performant funds than it is going to be get into the hot ones that have performed well for a long time. So I think before you do it, decide if you're going to make that commitment, because I think in 2021 especially, you saw a lot of families sort of getting really excited about venture because they saw the money that was being made. And they just jumped right in really fast with large commitments to, one of the first 5 managers that pitched them. And now they're probably regretting that. And they probably going, venture sucks, I don't want to do it anymore.
Yeah.
and quite frankly, that also hurts the entire ecosystem because now GPs are back a few years later going like, well, I need to meet a whole new set of LPs to raise my fund, and that's not good for anybody. So I think like you should really look in the mirror first and say like, am I willing to make this commitment to the asset class? So the last piece I'd add to that is you don't know you're good at this for at least 5 years, right? Like the GPs don't know, but for 5 years, but actually as like the timeline on this, you make a commitment to a fund this year, they're probably not calling capital at the beginning until next year.
Do I hear you sort of saying you prefer or you value higher the GP to GP recommendation versus an LP recommendation, or you're sort of building your own conviction based on, I mean, when you're sourcing, is that coming from?
To some extent, I think it depends on what kind of manager, and it quite frankly depends on the person, right? If you're like, so let's say there's a first-time GP or even a second-time GP, the only people who know how good you are people who've worked with you, right? Like just a matter of fact, there is almost no way for me to reference in to a first-time GP from other LPs. Like, you don't have any other LPs.
Totally.
Or even if it's fund one, you've had LPs fund two, you've had LPs for 2 years. They don't know that much about you yet.
Yeah.
So who's going to know you? It's going to be other people you've worked with in your professional life. And so if that's as an investor earlier, that's other GPs. And if that's as a executive or founder earlier, it's sometimes it's you as the founders, investors, which are also, by the way, GPs. So yeah, I really value GP references and recommendations a lot. That said, I value some GPs' recommendations a lot and others less a lot. And then I think it does shift a little bit for third and fourth time funds because then LP recommendations really matter because they've spent a lot of time at this point with the GPs. There's more of a track record to understand. And so I think it shifts a little bit for the more mature funds where the LP recommendations are more valuable.
For your first investments, what were the kind of key learnings you got out of it?
The first my experience of doing this at the beginning was meeting all of these super successful, super smart people that have made a lot of money as an investor or as a founder. And they were all like wildly more networked and knowledgeable and everything than me about venture, and quite frankly, in many cases, just about like life and business. And so you just want to say yes to all of them because they're so damn impressive. So that was the first expression, was like, oh, I want to say yes to all these people. Damn, they're good. You wouldn't be a VC if you're not really impressive. And then you're like, well, now I've met 25 impressive people. I can't say yes to all of them.
Yeah.
All right, which ones are more impressive? Why? And so, like, I still think highly of the first people I said yes to doing this job. I think they're really smart, really talented, really capable. But are they as really talented and as really capable and as disciplined, as good investors, whatever, as I think the current crop of folks I'm sort of saying yes to? No, I think the bar's gotten a little higher.
In our prep call, you spoke about your portfolio being a mess by design. Can you share what that means and why you embrace it?
I just think it's a lot more fun to call it a mess than it is to call it diversified.
Or opportunistic.
Or opportunistic, sure. Yeah, whatever the professionals like to use to describe the same thing. Right? Like, what is a mess? A mess just means diversified. It means opportunistic. It means I want to invest in the things that I think will make money. Mm-hmm. Not paying much attention to what vertical, geography, stage, sort of like silly classification or box you want to put a manager in. Like, the most important thing the most important dialogue running in the back of my head when I meet a GP is, are they going to make money? Right? Like, that's ultimately why I'm doing this. Make money by helping fund great companies that will hopefully matter to them. There's so many ways to make money in venture. So many, from going super early stage, super late stage, to international, to domestic, to everything in between. Doing funky secondaries, doing employee buybacks, like you name the strategy, I've been pitched it and heard it, and I think some make sense and some don't. If I was worried about, like, I need to go find a deep tech manager based in Austin and a health tech investor based in San Diego and a farm manager based in Boston, that would just tie my hands behind my back and stop me from asking the most important question. Do I think this strategy makes sense? Do I think this person is amazing? And do I think they're going to make a lot of money? And so as a result of like turning off the like box checking exercise, you end up with a bunch of really differentiated funds that are actually pretty different from one another. So I do think they're diversified. They're just not diversified across like the traditional metrics that traditional asset managers or wealth managers or whatever would sort of try to diversify you against, right? Like the classic is like stage, geography, sector. I don't think about which, do I have all the sectors covered? I just think about all my GPs awesome.
Is there a piece of that that relates to also how you're thinking about your deployment? I'm curious how regimented you are in terms of.
So there I probably follow what the institutions do far more than anything else. So as a family office investing in venture, generally speaking, you have a target allocation percentage. You say, I want 25% of my assets, whatever it is, to be invested in venture, and therefore you have X dollars today. In order to get to that target allocation, you're going to build a cash flow model and say, I need to commit X million dollars per year into venture. It's going to get called over this many years. It's going to be invested for this many years. And it's going to get back for this many years. So in order to get to my target allocation, I need to commit X million dollars a year. I'm absolutely running that model. That is exactly how I decide how much to invest or how much to commit every year. Date that every half year or every year, or to make sure I'm pacing as expected, adjustments based on everything else going on in our lives. And that is what helps me get to the commitment size number. So that is super important to do, because I also think like one failure mode here is to say, I want to invest $10 million in venture. Your first 3 years, you commit $3 million each year. And now in your fourth year, you're like, well, no more money for venture for 10 years. Great. And then you come back to it 10 years later and be like, how did I do? That is a very, very bad way to do this job. So instead, you need to do it more slowly, and you need to make sure that you're sort of never out. Because also, you always want to make sure some percentage of your portfolio is new managers, and quite frankly, that you're saying no to old ones. Because also, if all you're doing is re-upping with your existing set, sort of definitionally, that means it's like you're missing all the good new ones, and you're not constantly trying to raise the bar.
Now we're going to take a quick break to speak with our sponsor.
On the show today, we have our stellar partner and industry expert, Shane Goudey. He's the leader of Sidley's venture funds practice. And if you get value from this podcast, we have Shane and the Sidley team to thank for it. They make these recordings possible. We are looking forward to hearing from you, Shane.
No, I'm delighted to be here, Alexa. It's been a wonderful relationship with you and Earnest, and swimming with Allocators. You guys are the best. So we're glad to be part of it.
You are very kind. It takes a village.
It does, indeed.
You lead the venture funds practice at Sidley. Could you just describe for us the team and the work you do?
Yeah. So my focus, my day-to-day focus is working with venture capitalists of all sizes, shapes, creeds, and colors, the multi-billion-dollar per fund asset managers in the business, running all the way down to brand new emerging managers forming a $5 to $10 million fund. It really, truly is an entire ecosystem practice. Purposefully agnostic, because the fun is in who you get to represent on a day-to-day basis. So we really do it all. And, so I've started at Sidley about a year and a half ago. I was at another firm for a quarter century. So I've been swimming in the venture fund waters for a very long time. And they are wonderful waters to swim in. I find myself just energized and refreshed and loving what I do. Here at Sidley, I am the head of the venture funds practice. Our funds practice is, quite sizable. It's about 140 lawyers and representing all different sectors of the investment management space. I was brought over to Sidley to really bolster and build the venture fund side of the practice. We have a nice, robust emerging companies practice, but in order for us to be able to represent the full ecosystem, I was brought on to kind of be the last piece of the puzzle to help us really maximize our opportunities. So The team is now about 25 lawyers. It was, me about a year and a half ago. And so we've aggressively built and certainly used a lot of internal associates to build our team. And now we have a really great practice of people who, through lateral partner and associate hiring from, key other firms with deep experience and really the right frame of mind for how to represent VCs in doing this work, because I think there are a lot of people who can do the work of representing funds, but actually it's not just doing the kind of fund formation. You have to understand the market and the mentality and what it really means to be a VC and how that reflects itself in a fund formation project. So, we're really building kind of a practice that is built to be the concierge service for venture firms of, any size, any shape, and we're kind of built for speed and built for quality, and we're really excited about what we're doing, and the firm's been incredibly supportive, and we just we're enthusiastic to be a real great part of the venture ecosystem. So
it seems like as you've been building the team, we've also been seeing momentum build on the fund formation side. Can you share just anecdotally what you're feeling here in the end of 2025?
Yeah, no. It's absolutely nice dovetail to have to build a practice when things are getting busy. From a fund formation standpoint, it is as busy as it has been in the last 3 years. This is naturally a time of year when a lot of funds are doing their fundraising plans over the final quarter of the year to be able to kind of have a first closing around January, late January, early February, to take advantage of the fresh buckets of allocation for very large venture investors, but also people who, whether it's family offices or high net worth, fresh buckets of capital in their own kind of personal stakes to be able to invest. So just the natural time of year is great, but the market is really good now, right? We've got a lot of M&A and IPO activity. I've heard of a couple SPACs back again. The upside of the market is very busy providing liquidity for a lot of venture firms. And that obviously is the fuel in the tank for any of these firms to be able to fundraise. You got to produce returns. And from a time over the last 2 to 3 years where there hasn't been much of that, or you've had to be very, very creative about how to create secondary opportunities, this tends to be kind of relying on some of the more natural channels of M&A, IPO activity to have hope, at least, that things are starting to turn around. And if I look at the number of funds that are out there now raising, these are more, certainly not 2021 days, but big markets which have sort of been the hallmark of the last 3 decades. These are kind of a little bit of the evidence of what's gone on in some of those markets. Mm-hmm. So we're pretty excited in our sector of the world.
And now back to our LP interview.
On that piece, I would love to know how you're thinking about underwriting the individual GPs. Let's first start with net new relationships, because I can infer that you're very by the book when it comes to how much you're deploying and your deployment schedule. But I get a sense that from what you've said, you're not prescriptive on what you think you should be investing in. It's more about the people that get to meet. So talk about when you meet this people set, what are you looking for and how you underwrite?
There's not really a formula. You're looking for somebody that is really, really special and has a set of life experiences that shows just how special they are. And then you're looking for a strategy that fits that perfectly. That fits them as who they are perfectly. Them, like person or team, right? As a result of what I just said, there's 1,000 ways you can have impressive backgrounds, whether it be founding a company, whether it be being a great investor, working at a great institution, coming out of one of the impressive sort of institutions that makes the Valley run, like YC or the Teal Fellowship or whatever. There's so many different ways you can have a really impressive background and have a lot of reps of meeting, identifying, and picking great founders. I'm not prescriptive about it, but the important thing is that you are truly world-class at the thing you're doing. If I don't think you are top, venture is a game where if you're not the best people, you don't make money.
At all.
And so you can't say, they're really, really good, but I think there's a couple levels above them. Then just don't do it. Right. So you want like the best team, and you want them to have a strategy and a sort of approach that you think is perfect for who they are. And that as a result of, so if you find a person who is, manic and aggressive and like goes to all the parties, goes to all the events, knows everyone, needs to stay on top of everything, like probably a strategy that has them doing a lot of deals and, using that momentum and hype to get into sort of the more expensive rounds, like makes sense.
Mm-hmm.
Where if you have someone who's more cerebral and developing theses all day and doing research with founders and, industry experts and sort of trying to find overlooked startups in weird areas that fit, market opportunities that they're excited about, like that's just going to be a different strategy from a different person. Both can be successful, and there are examples of both of those strategies where they have been. The most important thing is that they're world-class at executing, and that they're the right type of person for the right strategy.
It's always interesting having family offices on because, they always say if you meet one family office, you just met one family office. Where do you think, I know you gave kind of the reason why you did it and you felt like your family should be investing in venture, but overall, where do you think, like what types of families who would be perfect for venture cap? And who should just stop right now?
I think the most important thing is that one of the principals likes it.
Mm-hmm.
Like for all the reasons that I sort of explained earlier, why it's hard, right? Like you got to meet a ton of them. It's pretty opaque. You have to do it for a long time before if you're successful. Yeah. There's lots of illiquidity. There's lots of like fear, uncertainty, and doubt as a result of that illiquidity. Like the most important thing is you have to like it. Because if you don't like it, you won't stick with it and you won't get through the BS to what is true and have the patience to sort of see that out. And so if investing in working in the world of venture and tech, with amazing young founders and amazing GPs backing them, like if that's not exciting and fun to you, don't do it.
Mm-hmm.
Like it's not worth the brain damage. It's too small an asset class. It's too idiosyncratic. It's too hard to understand. Like you shouldn't do it. But vice versa, if you find yourself reading the tech news every day and wanting to know what is happening in the ecosystem that quite frankly is driving the entire world forward, and also working with optimists, like in order to be in tech, you literally have to be an optimist because like every single founder has a 25% of chance of success, and yet they all think they have a 90% chance of success. And every GP has a 25% chance of making decent returns or less, and they all think they have a 99% chance of making decent returns or more. So all of us are kind of full of crap, but it's optimistic full of crap. And that's awesome. That's like a better way to live. Like you're like life will be more fun for you if you are a little bit too optimistic than a little bit too negative. But some people can't deal with that, right? You're going to meet 8 founders that all tell you they're changing the world and they're going to be successful. And in the back of your head, you're going to know that's not true. And some people react to that being like, this is all crap. I don't want anything to do with it. Others react to, man, I love the energy in here. I know the reality is this is way harder than everyone's making it seem, but I still love the energy and the vibe because this is how good things happen. So you need to have that frame of reference too. So I think that's like fundamentally the most important thing, right? Yeah. Because all the money aside, the opportunity, the like me trying to prove to you that this is a way to make money as a family office, none of that matters if you don't like it or not going to stick with it and do the work to get over that hump.
Yeah.
So that's what I would say. Also see sort of like the pattern I see in venture, a lot of family offices is first, if you've made your money in tech, naturally you're just way more likely to do it. That makes perfect sense. For the other families, often your first exposure to it is, you have a family business in industrials or real estate or pick your vertical. And so maybe the first step is go invest in a venture fund that's focused there.
Yeah.
Because then you get other value out of it other than just the investment. And so, even if you have your money stuck in an illiquid fund for a long time, you feel like you're getting value from talking to the GP. You can add value to the underlying portfolio companies, and that gets you interested in a way that is more visceral than just a number on a spreadsheet. And so that's also a good way, I think, to like dip your toes into it. As a family office, is like go invest in the funds that like have real connectivity to what you're already doing. And then decide after that, do you want to keep doing it?
Yeah. Do you have return expectations that are leading you either earlier or to first or second time funds? Or some family offices, I think the way they're starting to dabble is through some of these products where you can invest in really established funds. Curious what the role of your VC investments are.
I think it's like the family offices investing in the established fund. Like part of the logic there is that you don't trust your own intuition and judgment, and so you're using the brand name as a replacement for that. Like we do that in everything in our life, right? Like why do we shop and go to the store and buy Lay's potato chips instead of House Brand or whatever? It's because the brand is giving us the safety and security that product is a good one. And so one of the things that the mega funds have been really successful at is branding themselves. And so family offices see Andreessen Horowitz, Sequoia, General Catalyst, Lightspeed, whatever, and they go, I know them. They're an XYZ company I've heard of. Like this feels safer to me. I can trust the brand name. And so that's a super reasonable way to get started. Makes sense to me. And quite frankly, if you haven't developed your own investment judgment, like that's actually what you should do.
Yeah.
First, because I wouldn't trust your investment judgment either. But if you decide I'm going to be a real practitioner of this, then sort of naturally you go down the path of ignoring brand and doing the work yourself and deciding what you think is the best returning. I wouldn't say I have like explicit return expectations. I will say I'm an IRR investor more than a TVPI investor. I hate the adage of like multiples over everything, because especially as fund lives extend out, like if you get a 4x in 12 years, like that's not actually a good return. And you can invest in if you can invest in two 2x funds over that period of time, do that. You get extra liquidity in the interim.
Joshua, I have one fund investment I made a decade ago, and they're on like number 55. They are playing this IRR game down.
Like my total wire fees are like $1,000 per in this fund.
Seriously. Exactly.
That's hilarious.
Well, I forget was it Hamilton Lane data? I read some data that said like the median venture fund doesn't return 1x DPI for like 17 years at this point, which is just crazy to think about. So what I'm doing is in my cash flow model, just extending out the fund lives of most of these things.
Ooh, how far? Where do they?
I put a fund life of 17 years in, and honestly,
Yeah.
maybe I should make that 18.
That's insane.
It's nuts. It's nuts.
Very
At the same time, I think there's like aside, but like let's suppose you invested in a fund 15 years ago, and Stripe is their major position left.
Yeah.
So now you have Stripe on your cap, right? It's in a fund, but it's basically just Stripe. That's also not really a venture investment. Like it doesn't have venture risk. It's a big established company. We could argue what the price is, but I would say it's comparable to owning lots of other public market stocks, just without the liquidity. And so there is like a thing I ask myself, which I hope other LPs are asking themselves, which is if you have this big mature portfolio of real companies with real revenues, hopefully are profitable, and they're growing, they're just not public yet, and so they're durable, they growth stage businesses, like should they be in your venture bucket? Or should you move them into private equity or growth equity or something else? Because the underlying risk asset in there is no longer venture risk. It doesn't behave like venture. And so, if you think a typical venture book is now half of companies like that, maybe target allocation to venture should be up a little bit. I think we have to figure that out. I mean, the ideal solution is that we just get better at liquidity and people sell things faster. Like that's the actual ideal outcome. But short of that, if that's not going to happen, I do think we need to ask ourselves, like, what is the underlying character of the risk in a venture book that is very mature? And is it fair to sort of classify it all as venture and therefore make it a small percentage of your allocation, or should it be bigger given the risk is actually lower over time?
Are there any trends that you're like really following as far as in venture? I know AI is a big one, obviously, but that is helping you scope out of like, what I need to be looking for in managers over the next 5 years?
The first one that comes to mind it felt like the period from 2015 to maybe 2022, there wasn't that many really young founders anymore. It felt like the average age of folks was getting older. There was more repeat founders. The businesses that were getting started were in more complex industries that often required a bit more gray hair experience. I can't prove that, but it felt that way. And in the last 2 years, it feels like that trend has like reversed really fast, especially in AI land, where the companies that are winning are the ones that are just moving so fast and working 7 days a week, and are often 20-year-olds who are best at using all the latest tools and completely changing how they work. And so if you believe that's a trend, which I do, then you need to go, okay, well, the types of VCs that are going to back the 22-year-old kids are probably different, at least at the very early stages, are probably different than the folks that are more reliant on their existing founder networks and like existing sort of, in the ground relationships. It's partly why I was attracted to Dorm Room Fund. There's a few others that I feel have good exposure to that ecosystem in that world and are, backing the younger founders. Josh Browder is one I just backed. That invest in a lot of those younger teams. So I think that's one that I've definitely been noticing.
I think the repeat founder argument makes a lot of sense when you build companies using a particular playbook. But now that we don't have that many examples of companies that have been built AI first, AI up, then somebody who's got all the time and energy in the world is going to be just as an attractive bet.
Yep.
Those repeat founders, I want to invest in AI repeat founders. I want to get my money in after they've done it a couple of times, once you've had a couple of bets.
That makes sense. It is remarkable though, just like, I think, how old are the Cursor guys, the Mercor guys, like these teams are like so young. Like you literally, this is your first job or you dropped out, and like that hasn't. We know the Collisons and Alexander Wang at Scale and Mark, but like there's not that many of those. The fact that I can like list the famous ones sort of shows that. But it feels like this generation we're gonna have a lot, which is kind of awesome. But I do think requires a bit of a different way to think about getting early stage exposure.
I guess as a last question, Joshua, I just want to know what's next for Berkocorp. Berkocorp.
I mean, in venture land, I quite frankly, I think I will be running this strategy forever. Things I think around the edges is, how should I think about co-investing? There's a few other things in the back of my mind. Is that if I want to deploy more to venture, I think there's some interesting opportunities around the edges of like getting involved in prospective VCs even earlier in their journey. Maybe allowing some to invest off my balance sheet before they're ready to start a fund. There's some sort of ideas around the edges I have like that, but for the most part, investing in funds that I think are exceptional. Like I love doing it. I love the people I work with. I love being able to help in whatever small way I can. I love hearing about the companies they're investing in and seeing them grow and impact the world. So by and large, I quite frankly expect to keep doing what I'm doing for quite a long time.
Well, thanks so much for being on the pod. Really appreciate your stories. For part 2, we'll get more into, Joshua has a great mind of all things macro as well. So maybe that'll be another podcast that we do. But
that's great.
Thanks for being on, man.
Thanks, guys. It was a lot of fun. Really nice to spend time with you.
See you later, allocator.
After Portfolio Tile, investing with a smile.